Corporate finance, commercial paper financing. Fine-tune your finances with corporate finance. Commercial paper is another potential form of corporate financing. Commercial paper, generally short-term, unsecured promissory note, generally issued to the public in 25,000 minimum units. Forms of commercial paper could be finance paper, otherwise known as direct paper, finance or direct paper, sold by financial firms directly to the lender, or dealer paper, sold by companies through a dealer network. We also have book entry type of transactions, which means that it's going to be computerized, so no actual paper certificate would be taking place in that instance. What are the benefits of the commercial paper? It can be issued at rates below prime, so we could be issued at rates below the prime. There is not any compensating balance required, meaning we don't have that kind of instance we talked about in prior presentations where you might have that compensating balance type of issue, so that you have to basically hold on to some minimum balance in the loan, and you could have some amount or rate below the prime. So problems with the commercial paper include more lenders are risk averse due to many bankruptcies these days. So if there's a high level of risk that is perceived, possibly due to bankruptcies that have been taking place, then because this type of loan isn't secure and is of course built on trust, just like any kind of business transaction, they're going to be more hesitant with the commercial paper possibly. Companies that have downgraded credit ratings will not have access to the commercial paper typically. So if your credit rating is down, once again, trust is low, may not be able to get the commercial paper in that instance. Funds generated are usually less predictable in terms of the funds that will be generated, has less amount of commitment and loyalty that usually comes with a traditional type of bank loan, meaning when you're dealing with the financial institution, you have traditional lending type of situations with that financial institution. The financial institution is building a relationship with you with that traditional type of relationship, which is good because we would like to have a good relationship with our lenders, with our financial institutions, with, in other words, our banks.